Not rich yet.
Every client that has a mortgage, they ask me, should I fix it? Should I keep it variable? What should I do?
The real answer is you can't answer that question until you fully understand what's right in your own situation, but also on top of that, until you actually understand what the difference is between the two of them. Hey there, welcome to the Not Rich Yet show, where we help everyday Aussies take control of their finances. Jace, welcome back again, mate. I'm really happy to have you here. Today we're going to talk about fixed versus variable interest rates and mortgages and how they all combine into it. And why we're doing it is because it's one of the big common questions that we get asked, right? It happens to you how often?
Every day.
Every single day.
Every client that has a mortgage, they ask me, should I fix it? Should I keep it variable? What should I do?
Awesome. Well, we're going to hear all of the answers about that today. The challenge that I have is where as soon as interest rates change, everybody flocks to this one question. Should I fix it at this or that, or should I stay on variable? What do I do? And the real answer is that you can't answer that question until you fully understand what's right in your own situation, but also on top of that, until you actually understand what the difference is between the two of them. Because the big mistake, and we've spoken about it on other episodes, is that you just focus on the interest rate. If you continue to focus on the interest rate and ignore everything else, your mortgage isn't going to get paid off faster. No. So when we say that, why is that? What's your take on why you won't pay your mortgage off faster if you just focus on the interest rate, or whether it's fixed or variable?
People are forgetting that's should be basically almost the least of everyone's worries. Like the interest rate, they should be focusing on their structure, the actual product that they have, and utilizing that product to their advantage.
Awesome. So let's cover off the key differences between fixed versus variable interest rate. What is the difference between the two?
Yeah, the variable variable interest rates changes as the market changes. So it could go lower, it could go high. It changes in variances every single month, and it kind of depending on what the rate is of that today's market, it will go up and down based off that.
Yeah. So effectively, what's happening is the Reserve Bank sets the cash rate, and then that flows through to how much the banks need to pay in interest, or how much money that they receive for the deposits, and then so on. That flows through onto mortgages and interest rates, and also savings as well. So there's this concept of, all of the time, every single month, the RBA is making rate decisions, and then there's this big question about, are they going to pass on the rate rise or the rate cuts? And so in my experience, banks are really quick when interest rates go up to pass that on to the variable mortgages. When they go down, they sort of drag the chain a little bit in terms of discounting what they would be paying. And so where does that, if people are just paying more money in interest to the banks, where does that go? To the bank?
Yeah.
It just basically goes in their coffers, and they get more profit, right? It's crazy. So that's the variable one. So it's going up and down. We're sort of just meeting the market. Talk to us about the fixed one. What's that?
Yeah, fixed is an agreed upon rate with the bank. Usually a term between 1 to 5 years, 5 years being the max, 1 being the minimum, on a agreed terms. So say 5%, you will only pay that bank 5% no matter what for the next 1 to 5 years, depending on how long you agreed for that term for.
Yeah, and that can look like a really good deal, right? Because you've got the certainty of it. You know what your repayments are going to be for that period of time. You've locked it in for 1 to 5 years. And if interest rates go up over and above what you've fixed at, you look like an absolute genius, right? Now, if they go the other way and they go down, then you've overpaid and you're stuck in that. But that's sort of the gamble that you've made with it, right? So what's the difference then between, if you can fix your rate for up to 5 years, what's the difference between the interest rate for, say, 1 year fixing it for compared to 5 years?
Yes, there is a variance to that. The banks usually will give you the terms of that, and you'll see that, when you see the banks offering their fixed rates for 1 year, it's dramatically much lower than what it is for fixed for 5 years.
Yeah.
It's usually about a 1 to 1.5 point difference.
And that's because they're taking more risk, right? They don't know what's going to happen over 5 years, so they have to factor that in. One really interesting concept, and people definitely don't understand this, is that all of the banks pay so much money to economists to forecast and predict what's going to happen with interest rates. And the reason why they do that is because they need to know on their fixed rates whether they're going to be up, down, or sideways. So if they think that rates are going to go up over the next 6 or 12 months, they've already factored in that to the fixed rate. And so you'll always see a fixed interest rate is higher than a variable interest rate because they've already factored that in. On the other side, the variable one, well, you're making the gamble whether it's going to go up or down. Let's talk about what other benefits there are or what other takeaways there are off the back of, say, variable mortgage.
Yeah, so in terms of variable mortgage, it gives you much more versatility in terms of what you can actually do with that mortgage. The first thing being you can restructure that mortgage with other banks, so it will allow you to refinance without breaking kind of like a contract with them and paying a significant fee to that.
Yep.
The second being obviously being able to make extra repayments into the loan, which is very beneficial to people that can and afford to pay the extra repayment and shave off a bunch of interest that way. So those are the main key points for variable.
Yeah, so that's a really big thing that I don't want to skip over, is that the key difference between them is with the fixed ones, you either can't pay extra repayments to it, or there's a maximum that you can do each year, which isn't very much, compared to the variable mortgage, which means that you can make extra repayments to it. So if you sort out your finances, if you can put aside an extra $200 or $400 a week, then what that means is you're putting $10,000, $20,000, $30,000, $40,000 a year extra on the mortgage, which means you're paying it off faster. So it just goes to show it's another thing where sometimes you're so blinded by everything else, you're looking at specifically just one thing, which is that interest rate, and everything else just actually matters, which you're ignoring. Okay, so who are fixed rate mortgages more suitable for? Who are variable rate mortgages more suited for?
Yeah, so I guess fixed rates are suitable for situations where the client has a tight budget and they don't have actually a lot to spare after paying the mortgage and their expenses and their life expenses. This way they can kind of plan for the next 1 to 5 years, depending on how they fix it with a certain budget, knowing that they can't really go over that. And it can ignore the RBA going up or down.
Yeah, so just with that, like I remember I was working recently with a client and they had cut all of their expenses out because they had to, because their mortgage was taking up, we talk about 50%. I think their mortgage was taking up about 70% of their income. And so they were running on an absolute shoestring, and they couldn't take, if rates went up, it was going to knock them out. And so in that situation, they don't have the ability to make extra payments. So that wasn't really a consideration. And, they spoke with their broker and they spoke with us and they said, what's right under the circumstances? And the real big risk is that rates go up dramatically and they have to find an extra $1,000 a month. It just wasn't there in the budget. So that's where the fixed is suitable for those people. That's what you're saying, right? Let's talk about the variable one. Who's that more suited to?
Yeah, I mean, variable people who, variable interest rates really suit, people who have a comfortable understanding of if there is a spike or if there is a drop or whatever it is, in the worst case scenario, they can still afford to pay that, number one. And number two, where in their expenses and their budgeting, they have room to be able to save money and use that money to utilize to put into the mortgage to save interest and a lot of interest overall.
Yeah, awesome. So, it's not a one size fits all approach, but most people who I speak to, if they say fixed or variable, if they've got the ability to put some extra in, and what I mean by that is, stop wasting money on other stuff, reduce that down a little without sacrificing your lifestyle to create that surplus that you can put into the mortgage. Do that and have the variable one. I think over the long term, people get so fixated on this interest rate, but you can go and Google it, speak to ChatGPT, whatever. The fact is, when you're looking at 20, 30, 40 years of a mortgage, it's very minuscule, the difference in actual interest that you pay between fixed and variable. And that's because, and we keep saying it, trying to game the bank at their own game, you're not going to be able to do it. No. They've done all of the calculations at every level to figure out that this is going to be the thing that doesn't actually make any difference for them. So, Jace, let's talk about the fixed rate mortgage. And you fix it for 5 years and you're an absolute genius, and the rates have gone up by 2, 3, 4%, which over the last few years, that's sort of, we've seen that happen, right? Yeah. So we've seen a bunch of people who fixed at 2% and they thought they were absolute geniuses. What happens in real terms at the end of that fixed period if you've still got that mortgage?
Yeah, I mean, after that fixed term period, you go back to a standard variable rate. So meaning that you go basically to the bank's highest standard variable rate possible. Most customers who are on a variable rate are on a special price variable rate. So it's discounted and much lower than the standard variable rate. And it kind of baits customers who are on fixed to go either look to refinance or go back to fixed. And if they're looking to refinance, most likely the loan term will go back to 30 years, and they've added those extra years that back on their loan.
Yeah, perfect. So, we've got a situation where they've fixed it for 5 years, they've gamed the system somehow and absolutely fluked it. And then at the end of that period, they've been paying all of these repayments, and then they refinance because the interest rate's gone up to the standard variable rate. And then they refinance, and guess what? They forget to reduce down the term to 25 years. They reset it at 30. Guess who wins? Again, the bank wins because of one small mistake.
Yeah, and what people don't understand about refinancing and why it's so important is that the banks love when you don't understand how a mortgage works. So, for example, if a client has 20 years left on their mortgage, their repayments are $4,000 a month, another bank's going to offer you a slightly cheaper interest rate, but the repayments might be $3,000 a month because they stretched a 20-year mortgage back to 30 years. Now, your average Australian looking at that is, I can pay $1,000 less every single month. Most of them will say yes.
You've got a
bargain. That's a bargain. So I'm going to go, yeah, of course I'd like to pay $1,000 less. But in reality, you're paying hundreds of $1,000s more to the bank because you're paying an extra 10 years on that mortgage.
Exactly. And we've spoken about it in another episode. We'll put it down in the description or somewhere, the calculator that can tell the difference between that, and you can compare those between refinancing constantly at 30 years or dropping that down to 25 or even 15 to force you to pay it off faster. So if we sort of recap from this episode, there's a couple of things that we've touched on in terms of fixed versus variable. We've gone through and we now know the difference between that. We've got a situation where we know the limitations of the fixed rate, which is, we've got the benefits of fixing the rate and having that certainty, but we can't make extra repayments on it, or those are limited depending on the bank and the type of the loan. Where the variable ones, the risk is that it goes up and down, but you have far more flexibility in terms of offset accounts, redraw, and also how much quicker you can pay that off. If we've got people at the moment who are considering whether they go for fixed or variable interest rate type of mortgage, what's the sort of next steps or things that they should consider?
Yeah, I mean, definitely reviewing and structuring their mortgages and going to a professional to help structure and kind of look into their current situation. I really want people to understand that, we mentioned there's two types of people. There's fixed people who need a type of certainty, and there's also variable people that have the freedom to pay extra into the loan. If you're somebody who feels like, and you're listening, you feel like you don't fit either of those buckets, you might be somewhere in the middle where your budget's not too tight, but you can't pay so much extra into the loan. People don't understand that they can actually split their mortgage. And what that means is basically if you owe $1 million, you can split $500,000 as a fixed and then another $500,000 as a variable. And that gives them kind of almost best of both worlds in terms of some stability. And then the other portion is being flexible, paying extra into that loan.
So we can call that the old El Paso. Why don't we have both, right?
Yeah,
so you can have one, half of one and half of the other, and then so you're sort of hedging your bets against each one.
Exactly.
On that. Yeah, awesome. Yeah, so that's good because chances are you're not going to have, unless you're working with us, you're not going to have a huge balance to offset, and so you can offset it against half and still have the fixed part of that as well. Yeah, that sounds good. That's a good
Definitely.
that's a good sort of approach. All right, cool. I hope that everyone's who's been listening and watching this has got a bunch to take away from this. If this all sounds like too much, you understand the problem and want some help, obviously reach out to us. Jason and I are happy to help. Otherwise, we've got a whole bunch of other episodes on mortgages, finance, everything else to help you take control of your money that you've already got. And I can't wait to see everyone else in the next one, and also you in the next one, Jace. Thanks for a great day.
Thank you.
Awesome.